All right, look, if you click on this video, that means you want to invest correctly and you want to become a millionaire. So in today's video, I'll show you exactly how to do that using a very special index fund called VFIAX. Personally, this is one of my favorite ways to invest my money. And yeah, I made these slides because I'm really passionate about this topic. I really want to help you guys invest passively so that you can focus your time and energy on other things that generate income. And so yeah, feel free to take out a notebook and pen because we have a lot of ground to cover in these slides. But don't worry, I'll make it fun and interesting. And by the end of the video, you'll know my favorite strategy for investing in stocks. Like I said earlier, this is a completely free course. But if you guys do want to help support the channel, I'll drop my link down below to Webull because they're giving out a ton of free stocks and you guys should definitely take advantage of that. Let's get started with the course. Okay, VFIAX. This is Vanguard's S&P 500 index fund. Yeah, basically it was the industry's first mutual fund that offered diversified exposure to the US equity market. So essentially this fund, when you invest into it, it's tracking the S&P 500. These are the 500 largest publicly traded companies in the US. And right now this fund has a market cap of $158 billion. So yes, there's a ton of money within this fund and the minimum investment is $3,000. If you don't have that much money to invest right now, that's totally okay. There are some really great other options that we'll talk about later on in this video. So what are index funds and mutual funds? These are two terms that can sort of be used interchangeably, but in this video, we'll just refer to them as mutual funds from now on. So mutual funds are baskets of stocks that aim to mirror the average return of the overall market. So instead of investing in like a bunch of different stocks, you can make one investment into one mutual fund to basically accomplish the same thing. Basically by doing this, you are diversifying your portfolio. And so yeah, mutual funds, they really minimize your risk compared to if you invest all your money into 1, 2, or 3 different companies. In my opinion, mutual funds are one of the safest and most reliable ways to invest for the long term. I'll stand by that statement until the day that I die. So let's talk about the power law. So basically there's a phenomenon in the stock market known as the 80-20 power law. And it basically implies that most profits will come from just a handful of the best companies. In other words, of all the stocks that exist in the world, about 20% of them are going to generate 80% of the growth and returns. And that basically shows that it's really hard to find winners all the time. Statistically, it's very, very unlikely. So that's really why mutual funds are so important, right? So instead of owning individual eggs, we are going to own the entire basket. Yes, some of these stocks in the S&P 500 are going to be losers, but it's really going to ensure that we capture those winners as well. That's why I'm a huge believer of not really picking out stocks. A small percentage of my portfolio is in stocks that I pick myself. Rather, I put most of my money into mutual funds, index funds like the one that we are talking about today. And so if you look at the actual data, most people that actually pick stocks, they'll lose money or actually just underperform the S&P 500. Only 5% of large cap US stocks have outperformed the S&P 500 over the past 20 years. So yeah, it's super hard to pick out the winner. If you're a stock trader, meaning you trade pretty frequently, there's a very large percent chance that you are going to lose money. Even people that spend their entire life studying investing, different companies, all that stuff, many of them struggle to beat very basic mutual funds like VFIAX. So what I like to say is if you want to gamble, just go to the casino, bet 20 bucks, you'll probably lose and never gamble again. And if you want to gamble with your life savings, all your investments, then yes, you can pick out stocks yourself, but maybe put a smaller percentage into that and rely more on these types of funds to grow your wealth over the long term. The best way, in my opinion, to ensure that you're holding on to the big stock winners is by just investing in the overall pool. That's why I'm such a big fan of VFIAX. Now, when it comes to investing apps to buy index funds and ETFs, I highly recommend checking out Webull, which is an investing app that I personally use. So they have $0 commissions for stocks, ETFs, and options. There's no margin interest or short selling fees for intraday trading, and there's no deposit minimums, so you can get started pretty much right away. And they also have a cash management program where you can earn 5.0% APY on your uninvested cash. This is huge compared to the national average. And if we take a look at the recent list from the FDIC, we can see that right now the national rate is 0.45% on average for savings accounts. So yeah, we're over 10 times higher than that. Right now, if you deposit between $2,000 and $10,000, you'll actually get a $70 cash bonus. If you guys go to the app and click on cash management, you'll be able to take advantage of that promotion and start earning 5% APY on your money. You also have tons of platforms and products besides investing in regular stocks such as options, ETFs, fractional shares, cash management like we talked about earlier, smart advisors, and even an IRA account. And then inside of the platform, they give you access to advanced charting tools and in-depth market insights so that you can make the best investing decision based on the data. You guys can also use Webull on mobile, desktop, even their website. And yeah, if you guys are interested in getting up to 12 free shares, use the link down below to sign up with Webull and deposit any amount. This is an exclusive link for my viewers only, so be sure to take advantage of the 12 free shares, each being worth up to $3,000. Now let's get back to the course. Now let's talk about diversification. This is a really important concept, and basically what it's saying is it's not smart to put all your eggs or money into one thing, because yes, that single investment could go south and you would lose a lot of your money. And so we're trying to emphasize the concept that diversifying your portfolio is the easiest way to ensure you stay in the investing game long-term and keep making money for the rest of your life. And basically, VFIAX, this allows us to do just that. Another reason why diversification is so important is because it reduces the correlation of your investments to one another. So I know that's a little bit complicated, but basically, if you hold a mutual fund with 100 companies, it's very unlikely that all 100 are going to go up or down on a given day. However, if all the companies that you have are highly correlated to each other and they always move in the same direction, then your diversification through that mutual fund is not helping you much. So when it comes to picking out a mutual fund, it's important to invest in one that is super diverse in the types of companies it holds. One thing that I'll probably never really do is buy actively managed funds. So while some can be pretty similar to VFIAX, they are going to cost you way more money in fees. If you're paying, let's say, a 1% management fee, it doesn't seem like that much, but over time it adds up. And what I'll say is that portfolio performance, it's not guaranteed, but fees are. So essentially avoid fees if you can, focus more on passively managed funds like VFIAX, and it's very likely that this tip can save you over $1 million within your lifetime. The one number that we need to be really careful looking at is the expense ratio. So currently the expense ratio for VFIAX is 0.04%. This is much lower than most actively managed mutual funds. And that basically means your fees are close to zero. I'm frugal, I don't like paying fees, so this is something that I love. Now, what does this 0.04% actually mean? It means that, let's say for example, you invest $10,000 in VFIAX. Over 1 year, the fee that they are charging you is going to be 0.04% of your portfolio amount. So in this case, it's going to be about $4. Essentially, you're paying $4 for 1 year to not have to go out and buy 500 different companies' stocks. It's well worth it. Now let's also talk about compound interest. So in addition to diversification and low fees, the reason why a mutual fund can be so great is because it allows you to easily compound your investments. If you don't know what compounding is, it's basically exponential growth, and that's through math, right? Compound interest. Over time, for any long-term investor, they're going to see the benefits of long-term compound interest. And as Charlie Munger puts it, the first rule of compounding is never interrupt it unnecessarily. So basically, you want to buy something and you want to buy it and hold it forever. I know this sounds super easy, but it's actually very hard for most people to do. They get finicky, they want to actively manage, they want to sell, buy, whatever. But history shows that if you're just patient, you buy something and you just hold it for a long time, that is going to grow better than if you try to actively manage your portfolio. And a quick way to see compounding work is this quick example. So let's say you have $1,000 that earns 5% each year. After 1 year, you're gonna have $1,050. So right, that's a gain of $50. But for the second year, now we're getting 5% on that $1,050. And that basically means that after 2 years, you'll have $1,102.50. So that's an additional $2.50. Now compounding, there's not that much of a difference at the start, but once you get to 10, 20, even 30 years, that's when we see some crazy Without compounding growth, you just have a boring linear line, but with compounding, you get this really pretty exponential growth. And yeah, that's where you make a lot of money. So yeah, stocks come and go over decades. So compounding, it can be interrupted if a company, goes out of business or whatever, but VFIAX, they hold the biggest and best companies in the US. New ones are constantly being added. Companies which are dying are being taken out. So you can really count on consistent performance throughout the years. VFIAX is one great way to ensure that your compounding is never interrupted. Let's also talk about indexes. So all these funds, they're going to track some type of index. And in this case, VFIAX, it's tracking the S&P 500 index. I really like the S&P 500 because it's super diversified. But if you look at some of the other indexes out there, they may seem enticing, but they are not as diversified. For example, we have the NASDAQ, right? You guys have probably heard of this. This is extremely tech heavy. So the companies within the NASDAQ index, they're likely going to be related to tech. The Dow Jones is also another index that is not that well diversified, and that's because it only holds about 30 different companies. So right now, VFIAX holds about 506 different companies. The fund is market capitalization weighted, and it only includes equities. So there are no fixed income investments. It's a super liquid investment, meaning you can get out very easily. And I'd say that's suitable for investments of any size. If we do a deeper look into VFIAX, we can see that they have a price to earnings ratio of 23.4 and a price to book ratio of 4.1. We can also see that they have an earnings growth rate of 18.2% and a 24.6% return on equity. And if you look at the holdings, you can also see that it's very, very similar to the S&P 500, which it is tracking. Let's also check out the VFIAX dividend payment. Okay, so the most recent quarterly dividend issued by VFIAX was $1.58 per share, or about 1.59%. Over the last 10 years, the dividend yield has ranged between 1.35% and 2.07%, with an average of around 1.64%. Now, I love dividends because it's a great way to actually compound even more. Basically, all these dividends, they're going to be paid back into your account, and you have the option to reinvest it. And if we look at the historical performance of VFIAX, year to date, the fund has gone up by 16.87%, plus its long-term trend since its inception in 2000 has been steady at about 7.43%. And over the last 3 years, it's up 14.56%, and over the last 5 years, it's up 12.27%. If you guys look at the press, you know, everyone loves VFIAX. Forbes named it the best S&P 500 index fund. But you might be wondering, what if I don't have $3,000 to invest right now? What if I want to put less in, but invest into something that's very, very similar? Well, a really great option is going to be VOO, which is a Vanguard ETF. There's no minimum investment. It has an expense ratio that's even lower at 0.03%. And yes, since it's an ETF, you can actually trade it during market hours, so it is even more liquid than VFIAX. But yeah, essentially, these two things are the exact same thing pretty much. And so if you don't want to invest in VFIAX, you can just go with VOO. VTI is another ETF by Vanguard that is really, really popular. This one basically tracks the total stock market index, so pretty much all the companies in the US. And yeah, another great thing about VTI is that its expense ratio is also very low at 0.03%. This is a bit safer of a bet, but since it's not investing in the top 500 companies only, the growth has been a little bit slower than VOO or VFIAX at 13.75% versus 14.56% over the last 3 years. So if you want more exposure to the top US companies, then VFIAX or VOO is going to be better. But if you want a super, super diversified, I mean, we're talking all the different stocks in the US, then check out VTI. VTI is going to be basically the ETF version of VTSAX. Basically, what I want you guys to take away from this video is that you want to be diversified and you want to play the long game. I know it gets very, very easy to want to pick out really sexy stocks that are fun to have, companies that you really enjoy, using yourself. But most of the time, this is not the best investing strategy. I mean, I cannot predict the future. No one can. But based on past history, the biggest winners have been people that invested very diversely and for a long time. Any great and cheap mutual fund, index fund, or ETF is going to allow you to become a millionaire. And so whether or not you want to invest in VFIAX, VOO, VTI, VTSAX, it really does not matter. Any of these low-cost funds is going to be a great option. Just start buying as soon as you can. Put money in gradually. Don't touch it. Let it ride. And in 20, 30, 40 years, once you are taking advantage of exponential growth, you'll be wildly surprised at how much your net worth is. Anyways, I hope you guys found this video helpful. My whole goal is to help you guys invest passively, but not just invest passively, just to get into the whole investing game. Because if you want your money to grow and not lose to inflation, then yes, it needs to be invested in something. It can be stocks, it can be crypto, it can be self-improvement, it can be your businesses, whatever it is, you need to put your money to work. And for a lot of people, they really enjoy putting a good chunk of their money within an index fund like this. They buy it, they set it, they forget it, and they spend their time trying to increase their income. Hopefully you guys found some value from this video. Again, if you guys do want to get some free stocks from Webull, I will leave my link down below. You can also get 5% APY on your cash. If you guys enjoyed the video, make sure to hit that like button and also subscribe for more content just like this. I make a ton of videos about personal finance, investing, and entrepreneurship. Thank you so much for your time, and I'll see you in the next video. Peace.